If you're planning on retiring early, or if you already have, I want to tell you something that most people don't figure out until it's already too late to do something about it. And I want to be clear about something first. Early retirees are not people who got lucky. They're disciplined. They saved when others spent. They planned when others ignored it. They made sacrifices along the way that other people simply weren't willing to make. That's not nothing, that's everything. But there are 7 things that almost every early retiree that I've worked with found out about the hard way. Not because they weren't smart enough to figure it out on their own, but because nobody told them. And by the time they figured it out, the window was already closed to act on it or was closing very quickly. Today, I want to make sure you're not one of those people. And if at any point in this video you're interested in how these items might apply to your own situation, there's a link in the description. Feel free to book a call with my team. We look at this stuff every single day. And let's get into it. The first one is that the number that most people chase in retirement is usually the wrong number. Everybody seems to want to know what their number is, and what they mean is how much they need to build up their retirement accounts to before they can have confidence giving up their income from their job, transitioning into retirement. What number do I need to hit before I can quit my job? That's actually not the right number. The number that we should be more concerned with is what our retirement income gap is. The retirement income gap is the difference between how much you want to spend every month in retirement, how much you have coming in from guaranteed sources like a pension or Social Security. That difference is what will determine whether your retirement assets are going to last or not simply how large of a balance you've accumulated in your accounts. So here's a simple example. Let's say that someone's working with an arbitrary number of 1.2 million. That's the amount that they want to build their retirement accounts up to before retiring. So they work and they save and they get that balance up to 1.2 million, and then they go through this exercise for the first time and they figure out that their retirement income gap is $5,900. So they need to take $5,900 a month out of their accounts because that's what they want to spend in excess of what Social Security is going to cover after taxes. Well, if I take $5,900 and I multiply it by 12, that's $70,800 a year. That's their annual retirement income gap. And if we divide that number by their portfolio balance of 1.2 million, I get 5.9%, which means that they're going to need to distribute 5.9% of their retirement accounts every single year to make up their retirement income gap. And 5.9% might be possible, but it's a little bit too risky for my taste. We need to get that closer to 5% in most scenarios to have enough confidence that they're not going to run out of money in retirement or be in a really tight situation in the middle of a bad market. Now, your account balance obviously matters, right? If the account balance were 2 million instead of 1.2, that means that our distribution rate shrinks by quite a bit. So I'm not saying that the account balance doesn't matter, but it's not quite as relevant as the retirement income gap. Your retirement income gap should be the genesis, the foundation of your retirement plan, and most people are focusing on how large their accounts are. And those are two different things. The second surprise is that your tax bill in retirement is almost always larger than people think. We have a retirement system that incentivizes us to save in these retirement accounts on a tax-deferred basis. The IRS gives us these nice tax breaks for saving for our own retirement in exchange for being penalized if we take it out early. So we get to defer taxation on your 401k contributions and a lot of your IRA contributions, but the IRS is still waiting to tax us on those contributions, on the growth in the accounts, so they don't allow you to keep your money in there forever. You're forced to start taking it out when you're 75. And most early retirees underestimate this impact. The way this works is you take your account balance of your 401ks and IRAs and so forth at the end of the previous year, and you divide it by your life expectancy that the IRS gives us in actuarial table. Well, when you're 75 years old, your life expectancy is 24.6 based on this table. So if you have a $1.2 million account balance in an IRA, you take 1.2 million, you divide it by 24.6, I get a little bit more than $48,000. That's the amount you need to take out in year one. Most people underestimate this. So in this first year, you're taking $48,000, you're required to take $48,000 out, and that adds to your tax bill for the year. Now, the thing is, every year from that point on, every year you get older, your life expectancy goes down by about 1 year. So fast forward 10 years. When you're 85, your life expectancy factor is only 16. So if you take the same $1.2 million account, you divide it by 16, that mandatory distribution that was $48,000 in year one is $75,000 in year 10 when you're 85. So You're required to distribute a larger and larger portion, and that can often push you into higher tax brackets. It means that you might be paying more for your Medicare. If your modified adjusted gross income goes up too high, you have to pay the Medicare premium surcharge taxes. This has a profound impact over the course of your retirement. The reason this is a surprise during your accumulation years is that nobody really tells you about what the distribution details and requirements are going to look like. It's very easy to put your head down, go to work, make as much money as you can, and shovel as much as possible into those 401k plans. I think it's beneficial that they're so easy for a lot of people to participate in and enroll in. They take a little bit of money out of your paycheck. A lot of plans will increase the amount that you contribute automatically over time. These are great things. It helps people save for retirement. Oftentimes your employer will put money in on your behalf too. The downside is that for most people, they kind of set it and they forget it. And when it comes time to transition into retirement, now they're faced with all these complexities and details that didn't exist in the years that they were pushing money into the accounts. The third truth here is that health care before Medicare is simply going to be more expensive than you expect it to be. Most of us in retirement are going to get the majority of our health care through Medicare, but we're not eligible to enroll in Medicare until we're 65 years old. So if you're retiring early before your 65th birthday, you have a window where you're going to have to figure something out. And that might be continuing on a workplace health plan through COBRA, which is expensive in its own right. It might be getting coverage through your ACA marketplace exchange, your state healthcare exchange. That's the route most people go. And the amount that you pay for healthcare over these exchanges depends on your income. Now, the feedback that a lot of early retirees hear from their friends and other people is that, yeah, healthcare is expensive before Medicare, but it's manageable. The amount that we pay for healthcare through the ACA marketplace depends on our income. The less that you make, the less that you're going to pay. So if there's a healthcare plan out there that might cost $1,000 a month, if you're making $500,000 a year and reporting that much on your tax return, you're going to pay that $1,000 a month. But if you make zero, you're going to pay far, far less, perhaps nothing, because there's a government subsidy that kicks in the lower your income to offset some of those costs. The fact of the matter is that the way that these subsidies are calculated and applied to our premiums changed dramatically this year. And a lot of people who are on ACA marketplace exchanges are seeing a huge jump in their monthly premiums because the subsidies that they had been collecting since COVID have expired starting in 2026. And here's the rub. On top of the fact that the subsidy system has changed, there are now fewer subsidies, particularly if you're a higher income person. If you're retiring early and you're making up your retirement income gap by taking distributions from retirement accounts like your IRAs and your 401ks, those distributions count as income. That income contributes to whether you're qualifying for some of these subsidies. So in other words, the more that you take out of your IRA in early retirement, the higher your tax bill is going to be, and that means that the less subsidy you're going to get for your ACA healthcare through the government. This is kind of a double-edged sword. So not only has the system changed just this year, but if you're retiring early and you're taking distributions from your tax-deferred accounts, that's being added to your tax bill, and that could further suppress the subsidy that you might receive, which basically means you're going to need to pay more for healthcare than you may have anticipated. Our fourth truth today is that the 2 years before Medicare matter a lot more than the 10 years before your retirement. Sounds crazy, but it's true. When you go to enroll in Medicare, your premiums will be based on your income, not from the previous year, but from 2 years ago. And even if you're retiring at 60 and you're well into your retirement, well, when you make that Medicare transition at age 65, they're going to assess you a monthly premium based on your income from 2 years ago. The reason here is that every year when we file our tax return, we're reporting on income from the prior year. And when we do that, that's what Medicare uses to determine how much to charge us in monthly premiums. Medicare wants to start charging our premiums in January of every single year, but that's too early for us to file our tax return. We're not even able to file a tax return in January. We don't have to do that until the middle of April, and we can even extend our return all the way up until October 15th of the following year. So there's always a 1 year gap between the income that we report on our tax return and what Medicare is using to determine whether we have to pay these extra surcharges. And the 2 years before you enroll in Medicare matter more than the 10 years before your retirement, because that's the time when your income starts to count toward what your premiums are going to be. And if you're in a higher tax bracket, if you have a substantial amount of income, your Medicare costs are going to go up substantially. So to give you an idea of what these numbers actually are, this year in 2026, your Medicare premiums for Part B are $202.90. Your premiums for Part D are whatever your insurance company is charging you for that. Well, if you're married and you made $500,000 2 years ago, you're in a substantial Medicare premium surcharge tier. And instead of paying $202.90 a month for Part B, you're paying $649 a month for Part B. And whatever your insurer is costing you for Part D, they're going to tack on an extra $83.30 a month. And that's per person. Most people don't hear about this until the window is already closed because of that 2-year gap between the year that your income is counted and the year that it actually is reflected in your Medicare premiums. Now, if you're watching this video and you're starting to feel the weight of some of these truths, the unexpected tax bill, the cost of healthcare in general being more than you expected because your subsidies went away or your income was higher or your Medicare premium is being a lot larger than you expected, this is the kind of thing that my team and I look at every single day. There's a link in the description. Feel free to click it and book a call with us. We're happy to look at your full situation and talk through these items and make sure that they're not costing you any more than they absolutely need to. Our fifth truth today is that filing for Social Security early because it might line up with your retirement is a decision that compounds against you for about 30 years afterward, depending on how long you live, of course. This is a big deal. We all probably know that the earlier you file for Social Security, the lower your monthly benefit is going to be. You can file for benefits as early as age 62 based on your own earnings record. When you do that, you're locking in that benefit every single month for the rest of your life. And that can be attractive when you're retiring early. Filing at 62 can be attractive when you retire early because of that retirement income gap. If you're retiring at 60 and you're taking money out of your accounts in those first couple of years, it can be attractive to file for Social Security as early as you possibly can and minimize that retirement income gap to take some pressure off of your portfolio. Well, the fact of the matter is that when you file for benefits, you're locking in your benefit and therefore your retirement income gap for the rest of your life. And the math on this points to living at least until 82 or 83 as the break-even point for waiting to file. And so what I mean by that is by waiting to file for Social Security until you're 67 or perhaps even 70, you're locking in a larger benefit. So if you decided to file at 70 instead of 62, well, there's 8 years there where you're foregoing checks. You could be collecting Social Security during those years, you've just decided not to. So your retirement income gap is larger. Yes, it puts a little bit more pressure on your portfolio. The question is, how many of those larger checks do you have to collect in order to maximize the value of your benefits? If you wait until 70 and you file and then you don't live past 72, you would only have collected 2 years of checks. You should have filed earlier. But if you live into your 90s, you would have collected enough of these larger checks to make that worthwhile, which is really helpful to your long-term retirement plan. And the break-even point is about 83. So if you're using your Social Security toward expenses, instead of taking the cash and reinvesting it, doing something else with it, it usually makes sense to wait until you're older because you're minimizing your retirement income gap from the point you file for the rest of your life. Truth number 6 is that working one more year almost never changes the outcome of your retirement plan as much as you expect. A lot of people will work one more year just because they're scared or fearful or uncertain about whether they're in a position to actually step into retirement. It's an easier decision to make to just continue on the same path and give it one more year to see how things shake out. Mathematically, it doesn't really make that much of an impact on your retirement plan. Let's take the example of someone that has $1.5 million saved for retirement. Their retirement income gap is $5,000 per month. So they're going to take $5,000 per month or $60,000 a year out of their accounts. $60,000 is precisely 4% of their investment balance of $1.5 million, which tells me that that's probably a sound plan. If they're making $100,000 a year, they defer some of their earnings into the 401k plan to increase at $1.5 million, and they get a reasonable bit of growth on their investment balance. They might see that portfolio balance go up from $1.5 million to $1.6 million over the next year. And if you take the same distribution rate out of $1.6 million, it only increases your monthly spending by $333 a month. Now, that might be meaningful in some situations. distributions. But for most retirees, working one more year just doesn't change the math a whole lot. And not only does it not change the amount that you can take out of the accounts as much as you would hope, it gives you less opportunity for tax planning like Roth conversions and tax bracket strategy and capital gains and loss harvesting and those kinds of things that you can really use to your advantage when it comes time to managing required minimum distributions down the road. So you're losing a little bit of flexibility by working one more year, and in most cases, it doesn't change the retirement income picture all that much. And our last truth for today, number 7 on our list, is that the biggest risk to early retirement isn't actually running out of money, it's never giving yourself permission to spend it. We see this over and over and over again with people. If you're in a position to retire early, you're probably good at saving, you're good at the accumulation phase of the game. You've put money away, hopefully it's grown from investment growth over the years, and that's an entirely different skill set than taking it out and spending it. It's a different skill set, it's a different mindset, and that shift is very, very hard for people to make. In our practice, we see this come up in a lot of really common ways. One of them is someone retires early because they've set themselves up to be in a position to do that, and then they kind of nervously, feverishly check their account balance every single day because their level of confidence that what they're doing is right is pretty low because it's a little different than the more traditional path. Or they're reluctant to take that vacation, that bucket list trip that they've been planning for the last 10 years because they feel guilty about it, watching their friends and neighbors and family members continuing to work. These are very real things, and oftentimes people will simply pass away earlier than they expected without giving themselves an opportunity to enjoy the fruit of their labor and enjoy the resources that they've worked so hard to build up. The primary reason this happens, I think, is that it comes down to instinct, and the skills to accumulate enough to set yourself up for an early retirement are just simply very different than the skills to spending it down. It feels uncomfortable spending it down. When you're building it up, you want to be conscious that you're spending less than you're taking in. You want to be conscious of your budget. You want to try to put the pedal to the floor with your income and make more money to accelerate your path toward the early retirement. And by definition, when you're in retirement, you're taking money out of the accounts, you're at a monthly cash flow deficit. And that's a very uncomfortable feeling for someone that was so good at the accumulation skills that they were able to retire before the traditional timeline of 65-ish. Now, the cost of this is not financial, really. It's experiential. We all have 3 phases of our retirement. We've got the go-go years right after we retire that'll last for hopefully a long time, but every one of us is going to slow down over time. And it goes from the go-go years to the slow-go years and eventually to the no-go years. And the cost of being too timid to spend down your money is missing out on those opportunities. The financial side of it, it was never about the balance in your account. It was about the lifestyle that the balance was meant to support. That's the whole point here. So here are our 7 truths. Number 1, the number that you've been chasing might be the wrong number. The tax bill that you're going to experience in retirement is often larger than people expect. Healthcare before Medicare is going to cost more than people expect for a number of reasons. The 2 years before Medicare matter more than the 10 years before retirement. Deciding to file for your Social Security benefits early compounds against you for 30 years. One more year working often matters a heck of a lot less than people expect. And the real risk to an early retirement is not necessarily running out of money, it's not giving yourself permission to spend what you've accumulated. Now, this list isn't meant to scare you. Every single one of these items is actionable if you know about it now. That's the difference between learning about them too late and learning about them with time to do something about it. Now, if you're watching this and you're starting to feel the weight of all 7, paying attention to the right balance, your healthcare costs, tax costs, Social Security filing, giving your permission to spend, I have something that I want to show you that will make it all feel more manageable. Because once you see how simple the actual plan is, not easy, but simple, most of these truths feel less like threats and a lot more like actions that you can take. I walk through exactly what that plan looks like in this next video here. I'll cue it up for you. I would suggest watching that one next.